Hello, good morning, everyone, and welcome to the Basics of Binary Options webinar. I hopefully should be coming through loud and clear for everyone here today. So I think we have a few more people trickling in, but we'll get right into it and knock out the good fun stuff at the beginning that we do at the beginning of every webinar. So without further ado, we will jump right into our wonderful disclaimer screen. As you are probably familiar, if you've been on any Nadex webinar or any Nadex video, we always go through the screen, but it is important. And basically what it says is that trading on Nadex, just like trading anywhere, is going to involve risk. Make sure that you understand that risk before you put your money into any investment, trading, anything. And you don't want to be putting money into any sort of trading, any sort of risk that you can't afford to lose. So you definitely want to be trading with that discretionary income. You don't want to be trading with money you really need to pay rent, for example. The other thing that this disclaimer goes ahead and says is that none of this that I will tell you here today is a recommendation to buy or sell any financial instrument on Nadex or anywhere else. I will go ahead and be placing some trades on the demo environment today just to show you functionally how to go about and place a binary option trade and some of the intricacies that can go into that sort of binary option trade and how the products work. I am just going to be choosing them randomly, though. I'm not going to be really trying to choose any that do any sort of very positive return or anything. So just be aware of that and know that none of them are a recommendation to go ahead and trade anything, right? I'll leave this on the screen for just one more second. I think we have a couple more people straggling in here. So one other thing, if you do have, if you're not hearing me, seeing the screen, or if you do have any questions throughout the webinar, throw them in the chat. I have them up on my other screen over here. I gotta warm the mouth up to talk today. But I do have the chat up on the other screen, so throw your questions in. I'll get to them as they come in throughout the webinar. And let's move on here. We got this beautiful picture of me here. So just a little bit about me. I've been working at Nadex since 2017, so about 5 years now I've been working for Nadex. And the last 4 or so years, I've been focusing pretty much all of my time on both our products and our platforms. So all the new products that we've put out over the last 4 years or so, had to handle a lot of them from design to all the way through, and then also the platform that is our main platform today. We built that 2-3 years ago, and so I was heavily involved in the building of that. So that's one of the reasons I like doing these webinars, to explain our products and platform, just because I was around on a lot of them when we were figuring out how we want them to work and kind of what the what the use cases are for those products and for the platform. And just for my own personal trading experience, I've been trading since I was about 18, so that's more like 13 years now, and concentrating mostly in equity options. Dabble a little bit in futures, but not all that much. Yeah, and I do trade binaries, but only on the demo account. I cannot trade on the live account. You aren't ever trading against another Nadex employee when you are trading on that live account. All right, I think that's enough about me. So we'll move in here. So just an agenda real quickly. We'll go through this. I'm just going to go basically over the very basics of what are binary options, how they work, the risk and reward that you can expect on them, and that relationship between that risk and reward. We're going to go through closing a position. And then we're also going to go through a little bit of sort of how these are priced, and especially how these are priced in regard to the time left to the binary option and sort of the distance from each individual strike. We'll go over the different choices that you might have in products inside the binary option, as well as other products that we have on the platform. And then finally, we will go on to the Nadex platform, and that will probably take up a fair amount of time, just going through actually placing a trade, getting to see how a trade is placed, closing out a trade, etc. So we'll do a little practice at the end after we go through sort of the very basics of what these binary options are. All right, let's jump into the nitty gritty here. So what are binary options? These binary option contracts are going to be short term, and they're defined risk reward contracts. And really they're going to be based around, the slides as an event, a statement, a prediction. I mean, it's really anything, right? So the majority of the binary option contracts you're going to see on Nadex are going to be ones on your traditional underlying markets, right? So something like, will euro dollar be greater than 1,104 by today at 3 p.m., right? So it's just it's a yes or no question. Will this event happen, right? Will this be greater or less than this thing that is happening right now? But it's not just for like a strike price in a forex or any underlying market. It can also be for things like our event contracts that we have. So things I think right now we still have CPI event contracts up. Actually, maybe this expired yesterday. We always have a large number of event contracts up as well, and those are things like, will the overall CPI be greater or less than 0.7%, right, this month, or other things like that. But even things, and there are people out there that do sort of prediction markets on things like album sales or elections or other things that we might try to bring to Nadex in the future, but really all of those, it's simply just a yes or no question, right? The binary 1 or 0, yes or no. And so you can see down here, right, either the event happens or it doesn't. And on the binary options, at least on Nadex, you're always going to be able to kind of take the yes or the no, or sort of the buy or the sell, the long or the short position, right? And especially in those traditional financial markets with the traditional financial market underlyings, you can think of them as kind of a bullish long position or a bearish short position. On the other hand, depending on if you think the market will be going up or going down. So really there are 3 main components of any binary option contract that you need to look out for. First of all, there's the underlying market. We've talked about a few of those, right? It can be euro dollar, it can be the US 500, it can be crude oil, or it can be things like CPI, it can be things like an album sale, right? The kind of conditions, so the strike price basically, so that's the second part. It's going to be something like euro dollar greater than 11040, that the 11040, that's sort of the line of the sand, if you will. And then the third one's going to be the expiration time. So all the binary options are going to have an expiration time, and that is sort of just the time at which that prediction will either be true or false, right? So it's will be at 3 p.m. is that expiration time. There's always going to be a price range of these of 0. That's going to be the very bottom price of these can trade at, and 100 is going to be the very top price, or the very top sort of payout valuation that you can get from these contracts. And so the price, and this is a super important, I think, aspect that is somewhat simple, but not readily present maybe when you first look at the binary options, right? So they are a true or false prediction. Like we just talked about on the last slide, they basically go between 0 and 100. And while they are trading, while it is in the lifetime of the contract, right, before it gets to the expiration time. So I think in the example I was giving earlier, like 3 p.m. today. Before it gets to that, it's always going to trade in between that 0 and 100 point, right? At the expiration time, what's going to happen is either you are correct or you're not, right? You're correct or you're incorrect. If what you have predicted happens, right? If it's greater than whatever that strike price is, the option is going to settle. You're going to get a $100 payout. It's not the profit, right? That's the payout that you're going to receive. And if it's false, you're going to get a $0 payout, right? So that's sort of one of the other points of this. There are always 2 sides to each of these, and the person that's right is always going to get the 100. The person that's wrong is always going to get the 0. So it's always kind of a zero-sum game with the person that's correct and the person that's incorrect. But because these throughout the lifetime of the contract, they trade between 0 and 100, and you can sort of think of as the price that you're being shown at any given time for a binary option is going to reflect the probability that's being priced by the market of an event occurring, right? So what that really means, we have a couple examples down here. So when you're going into trading and going back to our example of 1104 for the euro dollar, you might see something like 46.25, 40 on the sell side, 49.25 on the buy side. What that means, because it's priced out of 100, you can take the midpoint of those 2 numbers, which is going to be 47.75, we see right down here. Well, that's basically, you can infer then that the market is pricing in a 47.75% chance that the event occurs, right? That on the buy side, that the positive of the event occurring, that it occurs, right? On the other hand, we have the sell side, and basically it's the exact same, except for you just need to remember that it's going to be sort of the inverse relationship if you are selling the contract, if you're taking the downward direction. What I mean by the inverse relationship is basically you just want to take 100 minus whatever this midpoint is. And again, it's going to give you that percentage. And you can see on both of these that you have the same kind of percentage probability being priced into the market. So this is always very important, right? That when you're looking at this, if you have a contract that's priced at 20 on the sell side, 30 on the buy side, right? If you're going to buy that contract, that basically means that the market is pricing in a 25% probability of that occurring. And as we go through the rest of this webinar, you'll see sort of how that probability of an event occurring also relates to the potential payout, right? So not only is it just the probability of an event occurring, but it's directly proportional, or actually it's inversely proportional to the return you should expect to receive on that, to the potential return on investment that you should expect. So I know that's, we'll get more into the actual nitty gritty of what I just said in a couple slides here. But this is a super important point that basically you can take a pricing of a binary option as the probability of that event occurring. So the risk and the reward of the binary option, obviously you're going to have the range of 0 to 100, right? We have gone over that, and $100 is going to be the total value per contract. The collateral you put up on any contract is going to be basically the maximum risk or the cost of the trade, right? So one of the great things about trading binary options at Nadex is that you always know how much you are risking when you get into the contract. If we go back to the last slide, we have a contract pricing. I think we had it pricing at, let's say it was at 50 on the buy side. If you get into that contract, you pay $50 to get into that contract. You are putting up that $50, you cannot lose more than that $50, right? That is your maximum risk that you can take. Is also going to be the cost of the trade. And that's basically the collateral that you're putting up to get into that trade, is that $50, right? So that's the buyer's collateral, right? That's always going to be the buy price, we see as we go down this slide. The seller's collateral is going to be very similar. It's going to be the difference between 100 and the sell price. So we saw in the last slide, we had the 100 minus whatever the price is. Again, when you are selling a contract, and especially selling a binary contract, the price you're actually going to be paying is 100 minus the price that it's showing, right? So let's say you have a contract trading at 85 on the buy side and 80 on the sell side, and you think that contract is going to go down or is going to expire below whatever strike point is present. What you are actually going to be paying on that contract is not 80 on the sell side, it's going to be 20, right? 100 minus 80, that's going to be the 20 that you put up, right? And so that's going to be, again, the full maximum risk that you put on to get into the trade. That is the maximum you can lose, and that is the cost also to get into the trade. So we call these contracts basically fully collateralized. And why we do that is because the buyer on every contract has to put up their collateral when they get into the contract. And the seller also on every contract has to put up their collateral on every single one. So if there's a contract, basically, any contract, let's say the one that we had on the sell side, the buyer gets in at 80, basically the seller is putting in 20 to that to make up that whole $100 range. And then at expiration of the contract, either the buyer or the seller will be correct. One of them will be correct to get the whole $100 payout. The other one will be incorrect to get the whole $0 payout. Basically, that whole collateral that both sides put into the trade at the beginning of the trade. You can never lose more than you actually pay to get into a contract, and that is something that can happen on many other sites. But at Nadex, these are all fully collateralized. There is no sort of margin there, and you always can. You're never going to have a margin call. You're never going to have to go back and put more money in on a trade. You always know your risk up front. And so we can look at this order ticket and sort of see what I was just describing just a second ago. But basically, if you get in on the sell side here, right, you're going to be paying 100 minus what you're actually paying on the sell side. And you can actually see that here we have 59 set up as kind of the limit price. And generally what you're going to be paying in your max loss is going to be exactly equal to what you pay to get in. So on the buy side, we see here, we have our limit price. So this is kind of what we're saying we want to pay to get in of $52.75. we see our max loss is also 52.75 because that is going to be the maximum we can lose is what we pay to get in, right? The maximum profit on any trade is going to be 100 minus what we paid to get in, right? Because we pay a certain amount to get in. The maximum payout is 100, so the maximum profit will be 100 minus whatever we pay to get in, and in this case, that's going to be 47.25. Here we can see sort of the inverse relationship that I was just talking about with the sell side contract. So in this example, we're saying we want to pay 59. Well, why isn't that saying 59 here? Because we have to remember that when we are doing the sell side, you have to do 100 minus the price that you are paying to get in, right? So 100 minus this 59, you're going to see that's going to be 41. That's actually what you're paying to get into the contract, and that's also going to be your max loss on the contract. And then again, the same thing for the sell side as for the buy. The maximum profit that you can ever make on any contract or any binary contract is going to be a 100 minus that whatever you paid to get in. So 100 minus the 41 is going to be the $59 that you can get for that max profit, right? Because the maximum profit you can get on any contract is going to be if you are correct, and you get the whole $100 payout. So we will get more in depth into some of the other things on this order ticket when we actually get into the platform. I think it's a little bit easier to show in the platform. I just want to go over these some of these points with sort of a static image first, because when you're on the platform, obviously these prices change every second. So this is important. You do not have to hold a binary option till expiration. There is going to be an expiration associated with every single one. However, you can trade in and trade out of a contract early. And oftentimes that can be the right move, especially for your strategy. If you get into a contract and the contract is now trading at a profit, you can actually go ahead and close that out early, take your profit, walk away, and maybe get into something else and not have your money at risk anymore, right? If I got into a binary option contract, let's say at 40, and a couple of hours later, it's now pricing at like 70 on the sell side, so I can sell out of it. I can go ahead and take that $30 profit basically off the table. Or on the other side, if I get it at 40 and all of a sudden the market just tanks on me, goes down, maybe now my binary option is worth 20, and instead of continuing to risk that entire 40, I can go ahead and close that out early. I'm still going to lose $20 on that trade if I close out at 20, but at least I'm not losing the entire 40, right? I kind of live to fight another day, if you will. So this is always very important, and it's something that I think when a lot of people first come in, maybe don't entirely understand that you can actually exit early. And there are other binary option shops, I think most of them sort of being the unregulated ones outside of the borders of the United States. A lot of those actually don't allow you to exit early. So this is, I wouldn't say it's unique to our products, because with most products you actually can get out early, but it can be a little bit different if you have traded binary options, maybe in one of the overseas shops. And again, we just to kind of show off how you can close your position early. This is what a closing deal ticket is going to look like on the platform. Again, I will show this kind of in real time on the platform when we get into a little bit later when we do some real examples on the demo environment. But this is how it's going to look, and you can see here, it looks like this person, I would have gotten into this at about 53.25, and I can set my profit target to basically get me out at 82.25. That's going to be a profit of $29, right? So you can set a profit target, or you can just close out at the current market price. So I'll show you how to do both of these when we're in the platform, but you can either basically set a level where you want to get out if the market goes up to that level. That's going to be sort of this first example, or you can close it right now. We have another sort of option for a different deal ticket. You can close it right now, the best available market price, and it will just give you whatever the best available market price is. That's going to be the one on the right. As you can see, the example on the right, you'd be losing about $3 if you closed at that price, right? If you get in at 53, you can get out at 50. I have a question coming in here. Will you be able to see, if you close the trade early, how much your loss or profit is? Yes. I'll show it a little bit more when we get into the platform, but very basically, yes, it is going to be this it'll show you in the deal ticket. It's also a fairly easy calculation, and also in the platform, and I'll show you this as well, sort of in the open positions panel on the bottom, you will always be able to see a running profit and loss tally. And that profit and loss tally is going to be strictly your profit and or loss if you were to exit that position right now, right? So any of you that have traded on the demo or the live environment before, you probably have seen when you get into a position on the bottom of the screen, it has that running profit and loss. An important thing to remember, and I will go over this point again when we're on the platform, that profit and loss is solely and strictly the profit and loss if you sell out now. It is not the profit and loss if the contract were to say expire right now. And that is a very important point that I will make sure I go over a little bit later on to sort of demonstrate the sort of differences between closing early and letting a contract expire. But yeah, that's a good question. And I have one more question that's coming in right before I move on. Is one free to open the trade and one to close? Oh, is one fee? Sorry, I read that wrong. Is one fee to open the trade and one fee to close early? Yes. So on Nadex, we'll go into fees super quickly. On Nadex, generally, it's going to be just $1 fee to get into a contract and $1 fee to get out of the contract. That you're also going to get that $1 fee at expiration of the contract as well. So there's no sort of extra penalty for closing early. The only thing to sort of remember is that if you hold a contract to expiration and you get a $0 payout, or you get anything under a $1 in the case of the call spreads and the knockouts where it's not just 0 or 100 at expiration, basically Nadex will never take a fee from you that's more than you're getting paid out. So what that basically means for the binary options, if you hold a binary option contract at expiration and you end up getting a $0 payout, right, you end up kind of being false in the expectation of the binary option. You do not pay that expiration fee, right? So in that case, you would just pay the $1 fee to get into the contract. You would not pay anything at the end. But if you exit a contract early, you're going to pay a $1 fee. If you exit a contract, or sorry, if a contract expires and you get a $100 payout, you will also pay a $1 fee on that trade. I hope that does clear it up. But I would think most of the time, if you're exiting early, you're probably going to be exiting for more than $1. So you'll still sort of be net positive over what you would if you just let it expire, if that makes sense. So moving on here, this is an important point tonight. There are a few different things that are going to go into the pricing of a binary option. And before I do start talking about the binary option pricing, I do just want to make it clear that Nadex itself is not pricing any of the binary options, right? So Nadex is solely just the exchange, or sort of the market house that everyone comes in to trade on. And the pricing of the actual options is made up by traders like you and by our market makers, who are basically traders but just much bigger and sort of provide liquidity into the market, right? So they're basically massive traders, and they always are putting prices out there into the market so that you can go and trade and get in and get out of a contract easily. So that's just one thing to remember, that when I am talking about pricing, these are like general principles of pricing, because Nadex itself is not creating the pricing. We create the contracts and the strikes for you to go ahead and trade on, but the pricing itself is made up by either our market makers or just, it's different types of traders. And I will show again that when we get in the platform, that you can actually put a trade out there and someone can trade against it, right? So, but this is generally how these are priced. And so there are really going to be three things that go into the pricing of any binary option contract. So I guess the first thing to really talk about is the probability of any event occurring is constantly going to be going up and down, right? I mean, the probability of it raining over my house today at 2 p.m., the weatherman might be super confident of that at 8 a.m. this morning, but at 1 p.m. that could change, right? The wind could blow the clouds away, basically, right? That's just a super simple example of the probability of an event occurring, and it's always kind of going up, going down as conditions change. And another important thing to remember is that the binary option contracts, while the price of the underlying market does have an effect on the price of a binary option contract, it is not linear, right? It is not a one-to-one movement. It's not going to be directly in line with that underlying market because it is only one of the factors that goes into how the price of a binary option. So there's really going to be three major factors, and we're going to go into sort of in depth into two of them, or not in depth, but we'll fully explain two of them. So first of all is the position, right? And that's the one I was just sort of talking about, is the position of the strike to the underlying market. So this is where the underlying market comes in, and obviously as the underlying market moves up, a contract is going to be more valuable on the buy side and less valuable on the sell side generally, right? Because as something starts moving up, if I have a strike price that's here, let's say that's will oil be greater than 100, as the oil moves up and up, right? There's more and more chance that it's going to expire in my favor because the underlying market's going above my strike price that it needs to be. And also the sell side, the price of that on the sell side is going to be going down and down as the underlying market moves up because there's less chance that event occurs, basically. So the position of the underlying market relative to the strike price is going to be a fairly large factor in how these things are priced. The second point is going to be the time. How much time is left until the expiration of the contract? And I'm going to illustrate this in the next couple slides, like how time plays in, because it is very important. But an easy way to think of it is, if you are closer to the time that an expiration is occurring, you're going to be more sure of that event occurring, basically, right? So if I just, for example, let's go back to our oil greater than 100, right? If I have a strike price at 100 and oil is trading at 105 and I have 3 days left for that to happen, well, there's a lot more chance that in those 3 days something's going to happen and oil might go up, go down, right? And so at that point, it's going to trade a lot more like right around 50-50, right? So, or something around there, maybe like a $60 on the buy side, right? Because it's right above the strike price. However, if oil's trading at 105 and my strike price is 100 and the expiration's in 5 minutes, well, at that point, that price might be something like $70 or $80 because there's not very much time for oil to go and move into a position where I'm going to be incorrect. So that's going to be a super important note as well. And then I will actually explain that a little bit more in the next few slides, and we're kind of go into a visual example of it. The third one is going to be volatility, and this one is a little bit harder to actually quantify. There are ways to actually quantify volatility in the underlying market, and that is priced into the actual price of the underlying market. The general rule is that as markets get more volatile, right, that there's a wider chance, there's more uncertainty in the market about what it's going to do. So there's a thing called IV, or implied volatility, that I won't go into super how it's calculated because that gets a lot more advanced, but very, very basically, it's just the implied, how much is implied that this market's going to go up and down, right? How choppy is this going to be? Something like a cryptocurrency, something like Bitcoin that is constantly just moving up and down right now, is going to have a lot higher volatility than something like gold or oil commodities that generally trade within a range. Oil might not be a great example right now because oil has actually been flying around these last few days with the world events being what they are. But generally, just if it's more volatile, there's more uncertainty in the market, and that is going to affect the price of the binary option itself. I did have a question come in here. Is this recorded? Yes, this is being recorded. It will be up on the Nadex YouTube channel afterwards, so you can go back and watch it. Generally, we get these up pretty fast. However, I think that the person that puts these up is actually on vacation right now, so it might not get put up on the website, or sorry, on the YouTube channel until tomorrow or maybe even Monday. I would say probably tomorrow. Generally, it's up in about an hour. All right, so moving on to the next slide here. So this is going to be sort of how we look at the relation of both price, kind of the price of the binary option, and how that relates to both the time that's left in it and where the underlying market is. So for example, so we sort of have, let's say this is we're looking back at what a market has done, right? And we're going to kind of say that this line over here where this ends, this is going to be 3 p.m. This is where it expires, right over here. And we have our nice line here. So this is going to be euro dollar greater than 1.14. So we have our nice 1.14 line. And we have the underlying market moving above, below, right, all over the place. And again, we're going to kind of say for this example that this, where my mouse is moving over here on this side, that's going to be 3 p.m. That's going to be the expiration of the contract. So early on into the contract, if you have something that's pricing, just over the underlying, if the underlying market is like just over that strike price, you're gonna have something right around, 50-50, or if it's just above, something right above 50-50, something like 54-58, right? So something like 54 on the sell side, 58 on the buy side could be a general price, right? These are all kind of general examples, semi-realistic examples of what a price might be. And then if the market goes down, goes below, just below the strike, not too far below, you might get something that's just below 50-50, right? 42-46, right? 42 on the sell side, 46 on the buy side, right? Because you're just below sort of that 50-50 proposition. And maybe in an ideal world with a ton of time left, something right on that line, right? If the market's like right at 1.14, you might get something right at like a 50-50. Because again, that's a pretty, generally, if it's right at the strike price, no one knows if it's going to go up or if it's going to go down. It's going to be sort of a 50-50 proposition. As we start to get closer, though, to the time that the contract's going to expire, you'll see here that, these are about the same level. They're almost exactly the same level. However, the pricing is starting to skew a little bit more. So what will happen basically, as we get closer and closer, as we get less and less time for this market to move and sort of be correct, we get less and less time, these prices above and below the market for the binary options are going to start to solidify a little bit more. So, or they're going to start to move apart. So while, if it's right above and right below with days left, you're usually going to have some prices like these, it's 54.58, 42.46. But as we start moving towards the actual expiration time, you're going to start seeing these prices sort of move around the midpoint. So anything above sort of that strike price is going to start to get more expensive. Anything below the strike price on the buy side is going to start to get less expensive because it's less valuable because you have less time to be correct. And so sort of moving on with that point, something as we keep going, right, this was about 54.58 right over here, and something, now that we have less time left, it's getting more to kind of 72.76, right? So a lot higher price, just because again, you don't have much time for that to sort of move back and for you to be wrong, right? So if I was on the buy side and buying this, I'm basically saying, okay, I'm paying 76 because there's less time for this market to go all the way down here. However, you can see that sometimes it does. And so, as you get closer and closer, we'll see here that, again, it just keeps going. That's just the point I'm trying to make, is that as the time starts running out, that you're going to see the prices sort of drift up or drift down, depending on if they're above or below, if the underlying market is above or below the strike price that you are trading on. And then at the end, it's going to be, if I was on the buy side here, I would, if it expired right at this point, I would get a $100 payout, and anyone on the sell side will get a $0 payout for that contract. And so we have another couple examples. These are just going to be really similar, and I'm going to go through these a little bit faster. But it's just sort of the same thing. As you can see in this example, rather than having the market move up and down above our strike price, maybe the market's just staying really flat, and we, our strike price is above, and the market just staying really flat below that strike price. And so you can see, again, we might have a 42.46, just like on the last one. But as we move down, the time's going to start ticking in, and we're going to have less time to be right. So the prices are going to start to reflect that we don't have much time for this market to move up. And then, as you can see here, right, if we're on the buy side right now, what we paid $46 for, let's say we got into this contract back here at $46, now that's only going to be worth $22, right? So maybe at that point I get out because I just want to get $22 back instead of potentially losing the entire 46 that I paid to get in, right? And then as it goes on, you're going to get a $0 payout. Again, these are all sort of on the buy side. If this was on the sell side, as this time moved on, your contract would actually become more valuable, and then you would get a $100 payout, right? Because it's below this line. And a very similar, we kind of have a third example here, but we're just going to show that one more time. this is sort of on the buy side here. If we are above the market for the entirety, again, you're going to have pricing like these. It's going to keep going just in the same manner that we were just talking about, right? And at the end, you would get that $100 sort of payout. So that's going to be how, I hope that was at least informative into how the time and the position relationship, right? Both the underlying market and the time relationship to the actual price of the binary option. At this point, we're going to switch over. We're going to go into the platform itself. I always like going to the platform and actually putting on some live trades. That helps me out the most anyway. So we are going to jump right over there. I already have my my nice excuse me. I already have my login screen up here. If you don't, if you haven't opened your demo yet, definitely go open one. It's free to do it, at least for the first 30 days, and then it's still free to have it open. You just need to fund your live account. You don't have to trade or anything. But I'm just going to log into my demo here. To get to this, you're just going to go to nadex.com, and then there's going to be a login button in the top right corner of your screen. So I'm going to log into my demo. Oops, I need to select this. This is my I like Nadex account because I do like Nadex and I like doing webinars for y'all. Type in my password, and here we go. This is our platform. If this is your first time seeing it, welcome. But we are just going to jump in and go over a few different things on the binary option. So first thing you're seeing here, and before I go any further, if you are new to Nadex, I do 4 of these webinars a month every Thursday at this time. Next week is going to be call spread and knockouts, and then I think the week after that I do a kind of in-depth platform one where I go super in-depth into everything that you could find on the platform, every single feature, functionality, setting. If you want to go watch that right after this, you can go to our YouTube channel. It's going to be up there, or just stick around till a couple weeks from now is going to be when I do the platform one again. So just for this example, we have been using Eurodollar a lot, so I don't know, why don't we go look at Eurodollar. So we have our binary options selected already on the top left, right? You can go to call spreads, knockouts if you want to trade those. For right now, I'm just going to do the binaries, and then we can select the different market classes that we offer. You can see them all here, and we can click into Forex, and then I think we said we're going to do Eurodollar, so why not jump down to Eurodollar? We see all our different options as we scroll down. We can also see all the different expiration times. So within all of these different expiration times, excuse me, as I click into each one of these, you will see, different strike prices for each expiration. Let's do a 2-hour one because usually the 2-hour contracts have a little bit better pricing. So as you can see, as I'm clicking into the different durations, the different expiration times, I have my different price ladders. And let's choose one that's right around where the market is trading. So one that would be pricing right around 40, right under 40 on, or sorry, right under the 50 on the buy side, right above 50. Right above 50 on the buy side, right under 50 on the sell side. Sometimes I just trip over my words. So right here, this should be right around where the underlying market's trading. And you can actually see here, this strike price is 1.10000. And we see up here, this market is trading at 1.0997. It's going to be a lot easier, though, to see it on our chart. So I'm going to take off my indicators. So we have our chart here in the middle of the screen. We have our selected price, and we have our deal ticket. So you can bring it up either selecting the actual number itself, or just hit the buy or the sell side. You also see that sort of shades in the area on my chart. I will make this chart a little bit easier to see, so bear with me. I do have one question coming in, and actually it's a pretty good one while I'm sort of over here in the price ladder. So let me find one. Okay, so here. The question is, if there is a blank or dash on the buy or the sell, what does that mean? Good question. So that basically means that there's no one is out there offering a price right now in the market. Because you always have to remember what you're seeing here, right? We aren't setting these prices. We aren't putting up these contracts for you to buy. That's going to be our market makers or just individual traders. And so when a contract gets so far away, so I'll click on one of these just to show you really quickly. And so just to here. So this is the strike that I have selected. You can see there's nothing here, right? There's no pricing here, but there is pricing on the buy side. That's basically because this is so far away from this that no one really wants to get into that trade with you, right? So it doesn't make sense for anyone to kind of take the other side of that trade because it's so far below the actual sell price, right? So basically, if you were to get into this, if you were to sell that contract, all you need to do is for the market to stay below this. Well, it's just so far away from this line that basically no one is willing to actually put that price out there and enter into a trade with you. So that's why there's basically no available pricing. And if you find someone that you can trade against, or if you go in and if you want to take this, you can go in and do something like this. And now my contract is up here. I'll show how that is done again in 1 second. But you can see I just placed a contract in here. Now there is $1 in there, right? But the rest of these still no one's in there offering the markets. So that's what that dash is going to mean. And basically you're going to see that very often, as you see here. It's going to be when the contracts get really far to either one side or the other. If we click on this, we can see it's all the way down here. When it gets really far to the one side or the other, it doesn't make sense for the person to sort of shake your hand on that and make the trade with you. Because remember, when you're getting into a contract, someone else is putting up money on the other side. And so if you are, even if you're putting in like $94 and the other person's putting in $6, they're sort of willing to do that because it's a little bit closer. If it's so far away, it kind of doesn't make sense for the other side to enter into that trade. So that's going to be what that means. I hope that makes sense. We're going to go back to the contract we were doing though. We have our euro dollar. We have our one that's sitting right around. Oh, it looks like the market's moving down a little bit. That's sitting right around. And you can see on the contract, and I'll make this a little bit easier on the eyes here. Oops, let's go down to a minute. So you can see here on our chart that you have all your strike prices kind of overlaid on the chart, and you can see each individual one, and you can kind of see them as a ladder on the chart as we move closer and closer to where the actual underlying market is. This sort of move up in price, right? Because it just makes sense for them to move up in price. If I'm paying $80 to get into a contract, right, it's going to cost me more to get into a contract where the underlying market is already in a position that if it expires at that position, I would get a payout, right? It's going to cost you more to get into that sort of thing. So let's just look for this example though at the one that's trading right around. So this strike price is 1.0996. We can see the underlying market is trading right around that 1.09955. So almost right on the dot. And just for this example, I'm going to take away these other strikes. Pro tip: you can hit the S button and it will deselect all the other strikes. And if you hit the S button again, it will bring them all back up. You can also do that by going to show. And these are all things that I will teach you in the charts webinar, little shameless plug, that'll be in about 4 weeks from now. Or you can watch the one I did last week. It will be on our YouTube channel. But so now we're just looking at just this strike, right? This is the one strike we want to look at. We're on a euro dollar. It's greater than 1.0996, and it's going to expire in 1 hour and 15 minutes, right? So it expires at where's the actual name here? At 2 p.m. Sorry, at 2 p.m. Eastern. And so we have 1 hour and 15 minutes left in the contract, and our indicative price is 1.0995. So that's about where the underlying market is trading. So let's say that I think that I want to get into this contract, right? I think this market is going to move up, and I think it's going to expire above this strike line, right? You can see right now on the chart that this market's trading below the line, but maybe I think it's going to go back up. So I can enter into a buy price. Got 52 on the buy. I'm just going to do a market price right now. Very basically, there's 2 different options you can have for. There's 2 different order type options you have. One is a market. That's just going to get you into the best available market price that you're being shown on your screen. The other one's a limit, and you can actually just choose a price to get in. And that's what I did a little bit earlier to actually show you that kind of $1 on that one that had the dash on it earlier. So let's just do a market order. We'll get in. There we go. We paid our $52.75. We can see it kind of go into our bottom little panel here. And we're in a contract, right? We're in a contract. We want it to expire above this line in the next hour and 13 minutes. Fairly simple, fairly easy. There are some things I wanna go ahead and show though. And so let's go to market. I'll just sort of show here. So if I put in 60 here, I just want to do this with the limit order just because it's a little bit easier to see. Again, just going over that point one more time, that the price that I pay is going to be my max loss. So if I put in like 60 or 30 or whatever I want to pay for this contract, you can see right here, the max loss is moving up and down, and it's also moving the max profit, right? The max loss plus 30 plus 70 equals 100. Just move that down. 20 plus 80 equals 100. So you can see here, if I pay 20 to get into a contract, the max profit is going to be that $80. I do see a question coming in here. I will get to that in just 1 second, because I do want to actually go over real quick. I'll get to your question in just 1 second. I do want to go over really quickly this panel here, this max ROI and probability in the money, because I think it's incredibly important for the binary option. And it goes back to what we were talking about with sort of the probability of an option expiring in your favor, right? So that very first thing we were talking about on the slides earlier, excuse me, very first thing we were talking about on the slides earlier is that this midpoint is going to be the probability of this expiring in your favor. And so we have the buy side selected, and it's really easily telling me on my deal ticket that it's basically just giving me the midpoint of these two numbers and saying, yeah, that's what the market is pricing in. The market is pricing in the probability of this expiring in your favor on the buy side is 45%, right? We can also see our max ROI going up and down. And this is important too, because if I go in, so I said earlier, the max ROI is inversely related to the probability. What does that really mean, right? It's also inversely, so very generally, if I were to get into this contract, actually, let's choose one down here. Well, so first, if I have a contract right around 50, right? So if I get into a contract that's right around $50 and I get a $100 payout, I would get a basically $50 profit, right? If that were my, if that were what I actually got at the end of the contract. So that my return on investment there, if I paid 50 to get in and I got a $50 profit, that's going to be 100% return on investment. And that's what ROI stands for, right? Return on investment. That's the maximum possible return I can get in if I get in at like 50. And so as you can see, as the price moves down, my ROI goes up, right? My maximum ROI goes up, because if I get in at 40, my maximum profit is 60, and that's going to be around 120% return, right? But you can also see that as these go down, the probability that this expires in my favor goes down, but the maximum return is going up. So you can see that right here in front of your eyes, this inverse relation is sort of happening. As the market's dropping, the pricing is dropping, the probability is dropping, but the return, the maximum possible return, is going up. And you can see that as well. Let's go down to like, let's see what this contract is. So let's say we have an $88 contract. Well, you can see here, if I were to get into this contract, I would have to pay $89, let's say, to get into this contract, and I'm only going to have a potential return, right, of 100. So my profit is only going to be $12. You might be asking, why would I ever risk $88, only make 12? That seems like a really bad proposition, right? I'm putting up a lot of money and I can only make $12. That's only like an 11% max ROI. It tells you right here. Well, the reason is because the probability that occurs is a lot higher, right? Because we're all the way down here. The strike we need to be above, like the underlying market's all the way up here, way above the strike we need to be above. Therefore, the probability that this occurs is a lot greater. So you're going to have to put up a lot more money to get into it, but the probability you get that return is much, much higher. Whereas if we go down to a contract, let's say one of these up here, if I can click on it, okay, if I can click on it. So on this contract, it only costs $9. I can get a $90 potential profit on this if it only costs $9. And you can see here, my max ROI on this is 900%. Insane max ROI, right? Like if that happens, that's a really, really crazy return on investment. However, the probability that happens is very low, 6% probability that happens. So again, you might be saying, oh, well, I'll always get into a $9 contract because I can get $100 out of it. So I'm putting up almost nothing for a $91 profit, or basically a 900% return. but the probability that happens is very slim. So that's kind of what you have to be thinking of. You have to be taking all of these into account, and you can't just be like, oh, okay, $9, that's cheap, let's go. Just make sure you're also thinking of the probability that occurs is much, much lower. So all of these are going to be intertwined with each other, both the probability that this expires in your favor, the amount you're actually paying to get in, and the amount you can actually get as a return. They're all tied together, and the probability is generally going to be inversely proportional to the ROI, right? As the probability goes down, the ROI is going to go up. As the ROI goes down, the probability is going to go up, right? So higher probability contract. So I think I've made that point. It is a very important point, so I do always like to really belabor. So I did have a question right before I started making that point, and it is a good question. The question is, what is the difference between the order and position? Also, how to tell P&L. Sorry, I'm gonna drag this out. It's getting cut off by my window here. Bear with me because I think that's just the end of the question. Okay, sorry if there's, okay, there it is. Okay, what's the difference between an order and position? Also, how to tell the profit and loss when it is an order? Good question. So I guess I'll start with the second question first. There is no profit and loss when it is an order. Why is that? Well, we'll go into what an order is. So we'll go back into what the order is over here. And actually, I'm just going to cancel this real quick. I'm going to delete it. So I'll show you, let's say, so a position first. So I got into this position earlier. I have already bought this contract, right? I paid it. I got it on the buy side. The money already came out of my account, right? I think I don't know how much I had earlier, but you can see my position value here. Let me, so like I already paid to get in. This money's already out there, right? I already own this contract and I've already paid and I'm in the contract, right? If I want to get out of the contract, I can sell early to get out, but I can't like just cancel it, right? Because I already own this contract, and the only way to get out is for someone to take it off my hands, for me to sell it into the market. Right, so that's fairly easy to understand. I did this, I bought it, I got in. What an order is the order panel is just a working order that you're placing that you're basically telling that I want to get into the market at this price, right? So if let's say go into this contract, this is pricing about $54 right now. Or actually, let's look into this contract. Let's say this is pricing at about $40, but let's say that I don't think this contract is worth $40. I think it's maybe worth 20. Well, I can't just go and buy something for 20 just because I think that's what it's worth. No one's going to sell me that because I think it's worth 20. It's worth 40. The market's trading at 40, right? But I can go ahead and I can put in an order for that. So I can basically say, if this contract gets down to 20, get me in at that time. So if I place the order right here, and remember, I'm doing this with the limit order, right? If I do a market order, it's just going to get me into the contract at whatever the best available market price is. If I'm doing a limit order, I can say, get me in at 20. Now, if I place this order, it's not going to get me into the contract right away because, again, I'm trying to pay $20 for something that costs $40. If you go to the store and try to do that, they'll kick you out. But here, you can at least put in an order to do that. And if this goes down to $20, at that point, it will fill. So all the orders is a working order that's saying, if this goes down to this price, get me in at that price. And so the reason there's no P&L there is because simply you're not in the contract yet. So there's no profit and loss to be had until this order actually goes in. And once it goes in, and actually, maybe let me try to. Here, I'll delete this real quick. Let me say, give me in at like 34. We'll see if we can catch one of these. So I'll say give me into this at 34. If this price goes down to 34, and actually you can see my price here. That's the other thing you can do is that all of these prices, you can put your best available price and it will show on the market. So if someone actually wants to get in and trade against my 34 right now, they can. All of you watching this webinar can go to this contract and trade against me and take this 34 off my hands, basically. Once this happens, once someone trades against that, or just generally the buy side goes down to that point, it's going to get me into the contract, and this order is going to disappear, and it's going to go over to the positions panel because at that point I will be in the position. Well, I'll keep going with, we just have a few things left to cover. I know we are getting close to the hour here, so I'll try to cover them somewhat quickly. But one of the other things I do want to cover though is this. Oh, and actually we see here. So the order I just had went away, right? It's no longer here. It came over to my open positions panel, and now I have a profit and loss, right? It got me in at 34. We can see this little price here that I had set, 34, and I am, the market's going against me, so I have a pretty big loss on that already. But we can see that that's sort of the difference between the order and the positions. So one important thing to know about this profit and loss column that you're seeing here is this is only the profit and loss if you were to sell out of the contract right now, right? It is not necessarily the profit and loss if the contract were to expire right now. And why is that? Why is that important? So if let's say I got into this contract, hold on, let me go out and get it to like a $20 contract here. Actually, let's get it to $13, right? I can pay $13 for this contract right now. Just gonna go, I'm gonna get in. Here we go. This is my $13 contract that I paid to get into. Let's say that before this 2 hours up, so the next hour, that this market goes all the way up to this point, right? Let's say it goes all the way up here, but it hasn't gone above this. My contract will likely be trading for a lot more than I paid to get into it, right? Because as we've seen, as the markets get closer and closer to that strike line, generally they're going to go up and up a little bit more, and they might be worth, somewhere around $50, right? So let's just, for example's sake, that in the next hour or the next 45 minutes, right? This market moves up and it's trading right around this point. Well, I paid $13 to get into that. If it's trading right around here, maybe I could sell out for something like $40. So what will be reflected down here would be a profit of about $30, right? Paid time to get in, I could sell it right now for 40. However, if this then expires, I will not be in the money $40. It is below this point. I have a buy side contract. I will expire and get $0 paid out, and I will take a $10 loss. So it is very possible for your profit and loss to be showing positive, but if the contract were to expire right now, you would get nothing. So that's just what a very important thing to think about these binary options. At expiration, all that matters is it above or below this line? Nothing else matters at expiration. Before expiration, if I were to get into a contract and it moves up significantly and I'm on the buy side, likely I will be able to sell that back into the market for a lot more than I paid for it and take a profit there, even if it's not above this line yet. That makes sense. And the same thing can happen for the other side too. If I were in a contract, down here and I paid, 93 to get in and the market keeps going, well, now on the buy side, this contract that was worth 93 might be worth 50. It's going to show me taking like a $40 loss, but if it were to expire, I would still get the $100 payout for a profit of about $6, right? So again, the other side can be true too. So it's just, I always want to make sure everyone is aware, because I have gotten a lot of questions on this before, that the profit and loss that it's showing is only the profit and loss if you were to sell into the market right now. It is not the profit and loss if the contract were to expire right now. All that matters at expiration is, on the buy side, is it above the strike price? On the sell side, is it below or equal to the strike price? So I hope that makes sense as well, because I know that does confuse, especially when people are a little bit newer to the platform and to trading binary options. I know that can be a confusing thing. All right, we are almost to the end. I know we're at about an hour here. I am going to go over just a couple more things. Really, I'm just going to go over exiting your contracts. So as we see here, as we kind of go across here, we have all of our different items on the order panel, or sorry, on the positions panel. And one other thing you can see here, the average price minus the current price on the buy side is always going to be the current minus the average on the buy side is going to be your profit and loss. And on the sell side, it's always going to be the average minus the current, right? So if we take $24.50, we subtract $52.75, we get about $29, obviously moved. So there's a couple buttons at the end of this. You can either set a profit target or you can just close. I'm actually just going to go over close first because I think it's a lot easier. So we can see here, super easy. This is the contract that I got into earlier. It was trading at 52.75. I got into it right before it dropped very heavily. So I'm taking a pretty big loss on this. Let's say I just want to wash my hands of this. I say, okay, I got this one wrong. Let's not lose the whole $50. Let's just lose 25 bucks and we can get out of this. So it's basically saying, do I want to close my position here? This is the average price I paid to get in, $52.75. The current market price is $22. And remember, that is the sell side market price. If you buy to get into a contract, you're going to exit on the sell price. If you sell to get into a contract, you're going to exit on the buy price, right? You always exit on the other price. So I bought to get in. I'm going to get this sell price back so I can close out of this contract right now for a loss of $30. I hit close position. There we go. I just sold my contract. I lost $30 on that trade, but I didn't lose the whole 100 or the whole, what did I pay to get in? 52, right? I didn't lose the whole 52. I just lost the 30 I paid, or the 30 that I was at that point. And of course, as soon as I sold it, the market bounced a little bit. I probably could have got a little bit more for it, but whatever, that's neither here nor there. The other button we have over here is our set profit target. So if I click this, I can actually set a profit target to get out. And here is basically that limit order that I showed earlier, that order that was over here. Basically, you can set a target once you're into a trade, at which point you want to get out, right? So I paid, what did I pay to get into this? 12 bucks. Right now I can sell it for $3.75. Not great, right? But let's say that I gotta go do something. I'm not gonna be watching this, but if this actually starts to go up, I want to get out if this, if my profit is, I don't know, 30 bucks, right? So if I type in 42.75 here, right? Because I paid 12.75 to get in. If it goes up to 42.75, that's going to mean I have a $30 profit target, right? 42.75 minus 12.75, $30. So I can go ahead and place this order. This isn't going to go right away, but it is going to go over and do a working order. So you can see that this popped up over here. And basically what's happening now is I now have an order out. It is saying, if this gets up to 42.75, sell the contract, give me my 42.75, get me out of the trade. I'll take my $30 profit. Bing, bang, boom, right? So those are going to be the two kind of ways you could set up your contracts to actually get out of the contract, or sorry, set up your trade to get out of the contract. You can also do it just manually by placing an opposite side position. If you aren't super sure about it, just use a set profit target. It's the same thing. But if I were to go in here and just place a sell side order on something I already have a buy side in, it's going to exit me, right? It just exited my position there. So that's really everything I wanted to really go over during this. If you do have any questions, I know we are a couple minutes over the hour point here. So if you do have any questions, throw them up in the chat as we go through this last little bit. I will do my best to go over any of them. While I am waiting for any questions to pop up, I am going to go ahead and throw this slide up here. All right, I'll just do it this way. So yeah, throw those questions in the chat if you do have any right now. I am going to put up our socials here on the screen. Go ahead, follow us on Twitter, Facebook. Get to the end here. Gotta click through all these real fast. There we go. So if you want to go ahead and follow us, Twitter, Facebook, Instagram, YouTube, LinkedIn, all the good ones, all the fine ones. This will be up on YouTube. Usually it's about an hour, but again, the guy that usually puts them up is out on vacation right now, so it might take a little bit longer. If you do want to go watch other videos, we have some short form videos, like 3 minutes that explain some things. We also have our whole archive of webinars on our YouTube channel. So if you enjoyed this, you like hearing me ramble for an hour, you can go back and watch other ones I've done on call spreads, knockouts, the platform, charts. Those are the 4 I usually do. Or stick around for basically every Thursday at 11. I also do one every single week. that it sort of rotates. So I think next week is the call spread and knockout webinar. If you do have any help, if you do have any questions that I didn't answer on this or that you're not throwing in the chat now, you want help with later, you can email us at customerservice@nadex.com. That's probably going to be the easiest way to get an answer, or hit us up on the live chat on the website. That is also a very fast way to get an answer from us. And finally, if you are enjoying Nadex, going to Trustpilot, leaving us a review, it does help us out. So I am not seeing any other questions come up in the chat. I'll give it just one more second here, see if we get any more. All right, last call for questions. I'm not seeing any more. So thank you all for coming and hanging out. I know I almost always go over that hour. We're only about an hour and 5 minutes here, so not too bad today. But thank you. Thanks for coming and hanging out, letting me ramble for an hour or so. I really love doing these and trying to help and teach people and answer any questions anyone has. So it's a lot of fun for me. I hope you guys and gals out there learned everything. And I hope that you all are staying safe. The world never seems to get any less crazy. And best of luck in all of your trading. Have a great rest of your day, everyone.